Hey traders, this is Blake Morrow with Trader Summit, and with me today is Eric Basmajian from EP. Is it EPB? I'm going to get that all screwed up. You tell me where you're from.
EPB macro research.
Dang it, I knew it. I had it. It was on the tip of my tongue, and then
You had
it. So welcome back, Eric. How are you?
Great. Thanks for having me back.
Oh, it's great to have you. You know, it's amazing how quickly summer wraps up, and here we are going into the fall season. Volatility is sure to pick up, and us here that are trading the markets, we're looking forward to more volatility and probably a lot of movement from both equities, maybe some central banks going into the fall. But I wanted to ask you, here in the U.S., and I think we can talk U.S. pretty centric right now. Inflationary pressures seem to be really, really persistently high. So how are you seeing inflation right now, and where do you see it going moving forward?
Okay, thanks, Blake. So the way that I look at the inflation situation right now, for starters, just so we can be on the same page here, the way that I calculate inflation is on a metric called a smooth 6-month annualized growth rate. And it moves similar to a year over year type calculation, although there's some subtle differences. And based on that measure, the CPI is up at about 6.5% now, which is the highest level in some number of decades. And when we look to forecast inflation, one of the most telling indicators of where inflation is going to be headed in the future is the growth rate of industrial commodity prices. And the reason that it's such a good inflation indicator is because it picks up commodity price inflation. We know that commodities themselves influence CPI quite a bit, but it also gives you a really strong read on the global industrial production cycle. And the global industrial cycle, or the global manufacturing cycle, has really strong inflationary implications through durable goods and excess capacity and things like that. So when we look at the growth rate of industrial commodity prices, they peaked back in April. So they peaked some number of months ago. So historically, if it was in normal times, such a lag between the peak in industrial commodity price growth to where we are now, we would have already seen inflation starting to come down. But we haven't. Inflation has actually continued to go up. And we know that the reason is because of supply chains. And we know that for two primary reasons. One is that if we look at various measures of supply chain disruptions, one of my favorite measures is in the ISM report, the Institute for Supply Management. They have a measure called supplier deliveries. So sort of the lead time for deliveries that manufacturers are receiving. And over the past 2 months, that's come down. So what we're seeing is that supply chains are still constrained, but broadly, they're starting to ease a little bit. And it wasn't until a month or two ago where we had peak supply chain disruption. So despite the fact that the commodity price growth was coming down, we still had supply chain bottlenecks that were keeping the inflation rate higher than it otherwise would have been. And we know that the supply chain disruptions are localized at this point to very select goods. So how do we know that? We know that because the Federal Reserve also publishes a metric called the 16% trimmed mean CPI. It sounds kind of fancy, but all it really does is it takes the monthly changes of all the goods in the CPI basket. It takes out the top 8% and it takes out the bottom 8% and it leaves what's in the middle. And that's the inflation rate for the month. When you look at that trimmed mean CPI, based on the way that I calculate it, that smooth 6-month growth rate, it's about 3% right now, which is almost 350 basis points lower than the headline CPI. So if you remove just those top 8 components, it removes 300 basis points from the CPI. And that spread between the headline CPI and that trimmed basket is the largest spread we've seen over the last 30 years. So we have a super intense concentration of inflation. That concentration is based on the supply chain disruptions. And the other more organic measures of inflation that we would look at, like commodity prices, have already come down. So a long-winded answer of saying that a lot of the main inflationary pressures have already started to ease. headline CPI is remaining higher than it otherwise would have been because of supply chains. The data suggests that that's starting to ease. So as a result, we're probably going to see the inflation rate start to come down, whether it be in the next report or the next couple of reports. So by the end of the year, we'll see an inflation rate, in my opinion, that's quite a bit lower than what we have right now.
Okay, now so that kind of answers a question that I have in my head. So inflation is coming down, but that doesn't necessarily mean that prices are going to come down. It's just the rate is changing, or is it that prices might come down too?
Prices may come down. I don't have a forecast that we're going to see outright deflation yet, but you make a very, very important point that it is the rate of change or the direction that I'm particularly concerned about. So we've seen the rate of inflation go from, when it was, we had the COVID pandemic, the inflation rate dropped to about 1% or 0.5% on the smooth 6-month growth rate. Surged up to about 6%. We're going to see that go from 6% down to 5-4. So the direction is going to be coming down. Now, the reason that's important is because we also have real economic growth. On the other hand, we have growth and we have inflation. Yeah. Real economic growth already peaked empirically back in March. So we've had the real growth rate coming down, but the inflation rate coming up. And that's why the Fed has been in this box. The Fed's going to likely move at the end of the month in terms of announcing the removal of some policy accommodations exactly at a time when the growth rate's going to be coming down and we're going to start to see the inflation rate coming down.
Now, I was just going to ask, that's probably not a good thing, just thinking out loud here, but how's that going to influence the way that you're viewing the Fed in the next few months, and how's that going to affect risk assets, and how's that going to affect the real economy?
Yeah. So in the lead into this, you talked about how we're hopefully going to expect some volatility, and when you have the Fed tightening policy into a slowing economy, volatility is usually exactly what you get. And when we look at the direction of growth, I think we talked in the first chat a couple of weeks back that when the growth rate in the economy is coming down, that's when you get all your corrections in risk assets. So I just noted that the growth rate of the economy peaked in March, about 6 months ago, and it's come down. So what's happened over those 6 months is we've seen a shift sort of under the hood. We've seen that the broad market has continued to move higher and significantly higher, but it's been dominated basically by one sector, which is technology. Technology is up almost over 20% in those 6 months. But if you look at the cyclical sectors, the sectors that need growth to accelerate, they've been very weak over the last 6 months. For example, the Russell 2000 is only up 3% in the last 6 months compared to over 20% for tech. Right. Regional banks are down 6% over the last 6 months compared to a defensive sector like utilities, which are up 17%. Long-term treasury bonds over those 6 months are up over 10%. So as soon as the growth rate inflected, we saw a change in asset dispersion towards defensive, durable, large cap stocks and safe treasury bonds, and a shift away from the stuff that was performing really well coming out of the sort of the reopening trade, which was the Russell 2000, the banks, specifically the regional banks, things like that. So with all that said, you're going to have the probability for more cyclical corrections with or without the Fed, just because the growth rate's coming down. Now you couple on top of that the Fed's starting to lean in a hawkish direction. And when you have the Fed tightening policy into a slowdown, what ends up happening is the yield curve starts to flatten. And we've seen that really dramatically since March, because the bond market starts to forecast tighter financial conditions into slowing growth. And that tighter yield curve has implications throughout the economy in terms of lending. So it's not inconsistent throughout history that the Fed is likely to act at exactly the wrong time. To give you an example of how this happened just the last cycle, in 2016, the end of 2016, President Trump won. Had not really much to do with President Trump winning the election, but the economy was in the middle of an economic cycle rebound, mainly coming out of China, industrial output in China. So the growth rate in the economy was accelerating in 2017, and it was accelerating into 2018. And the Fed started this really aggressive tightening program where they were raising interest rates and shrinking the balance sheet. As we moved through 2018, the market became convinced that the economy was actually starting to decline. But if you remember, the Fed made the famous comment that we're still going to raise rates and the balance sheet is on autopilot. Despite the slowing economy, the market basically imploded in December, and then the Fed quickly pivoted. I'm not forecasting an implosion, but what I am suggesting is that the Fed is going to move in a direction where they're going to be tightening policy into a slowing economy. You have to be on the lookout for corrections, most specifically in the cyclical assets like Russell 2000, banks, industrials, materials, and things like that. And if there is a meaningful response across asset markets, like usual, I would expect the Fed to turn pretty quickly. But the main concern is that they're going to be tightening policy into slowing growth and likely slowing inflation.
Well, so I wish I had the sound of the buckle up your seatbelt on a plane sound, and I don't have that in front of me right now. But Eric, I think that's going to be our cue.
That's right. That's exactly what I think.
All right. Well, Eric, on behalf of the the Traders Summit community, I just want to thank you for spending your time with us. I love your research, and for those of you that don't follow Eric on the Traders Summit site, make sure you check out his bio, see all of the other research pieces he's put up on ours, and how do people get a hold of you specifically?
So you can reach out on Twitter at EPB Research, and or you can shoot me an email, eric@epbmacroresearch.com, or just go on the site, epbmacroresearch.com. There's a contact section there. And I just want to say thank you for giving me a chance, as always, to share my views, and I really do appreciate that.
Well, we appreciate having you here. So thanks again, Eric, and we'll talk to you soon.
All right, great. Sounds good.